When you think of a strong, defensible business, like what pops into your head? A powerful brand maybe? Some unique tech? Well, for one of Canada's biggest companies, its defense might just be built out of pure steel, running for hundreds of miles.
So let's get right into it. The big question we're asking is this. Is Canadian Natural Resources, ticker symbol CNQ, a good investment right now? I mean, they're an absolute giant in the energy world. But does being big automatically make them a great stock to own?
To figure this out, we're not just throwing darts at a board. We're going straight to the source, digging into a super detailed equity research report from the folks at Morningstar. They've done all the heavy lifting, so let's unpack their analysis and see what they found.
Now, to really get a handle on where this company is today, we've got to go back in time a little bit. Because for years and years, the entire Canadian oil industry was dealing with a massive, and I mean massive, problem.
Okay, first things first. Let's meet our main character. Canadian Natural Resources is a titan. We're talking about the #1 largest oil producer in Canada and their #2 in natural gas. Their operations are just vast, covering the whole shebang from huge oil sands mining to thermal extraction and your more typical drilling. But here's the thing. Being a giant wasn't enough. For a long time, CNQ and all their peers were basically stuck. They were brilliant at getting oil out of the ground, but they had a huge problem actually getting it to market. Think of it like a 6-lane superhighway that suddenly just funnels down into a single dirt road. That was their pipeline problem.
And that dirt road, it had a real tangible cost. It created this thing called price differentials. In simple terms, because there weren't enough pipelines to get their oil to the best customers around the world, Canadian companies had to sell it at a discount. They were literally leaving cash on the table with every single barrel.
So, here's the crucial takeaway from all that. Because of this huge structural disadvantage, Morningstar's analysts concluded that Canadian Natural Resources had absolutely no economic moat. And a moat is just that special something, a competitive advantage, that protects a company's profits over the long haul. CNQ didn't have one. They were totally vulnerable.
But then the whole board was flipped. One single development came along and completely rewrote the story for Canadian oil.
So what was it? What was this big thing that changed the game? Well, it wasn't some flashy new technology or a sudden discovery of more oil. No, this was about good old-fashioned engineering and construction.
It all came down to one word: pipelines. That bottleneck, that single dirt road that had been choking the industry for years, was finally about to get blown wide open.
And listen, we are not talking about a small fix here. The scale of this was staggering. The Trans Mountain pipeline expansion tripled its capacity. It went from moving 300,000 barrels a day to almost 900,000. That dirt road we talked about, it just became a superhighway overnight.
So you can probably guess what happened next. This massive new piece of infrastructure had an immediate and profound impact on how the experts viewed the company's core business.
And you don't have to take my word for it. This quote from the Morningstar report says it all. We are assigning a narrow moat to the firm. Why? Driven by new pipeline capacity. It couldn't be any clearer. The problem was the bottleneck. The pipeline was the solution.
So let's be super clear on what this means. Canadian Natural Resources went from having zero competitive advantage to having a real, defensible, narrow economic moat. In the world of investing, that is a huge deal. It signals a fundamental positive shift in the business itself.
Okay, so the moat is now in place. What's next? Where does the growth come from? Well, the analyst lays out 3 pretty distinct possibilities for CNQ. So their whole growth strategy is tiered, and it all comes back to, you guessed it, pipelines. Step 1 is kind of a no-brainer. Just flexibly ramp up their conventional production to fill that new capacity. Step 2, which the analyst thinks is the most likely scenario, involves bigger investments in thermal projects, but only if existing pipelines get even bigger. But step 3, the really big one, a massive new mining project, that's a whole other ballgame. That would probably only happen if brand new pipelines get built from scratch.
All right, so we've got a company with a brand new moat and a clear, albeit conditional, growth plan. But does that make the stock a buy today? Let's get to the bottom line, the valuation.
You know, the report kind of lays out the 2 sides of the coin here. The bulls, the optimistic folks, are saying these new pipelines are a game changer that give the company flexibility to make smart investments. But the bears are pumping the brakes. They're saying, hang on a second, building more brand new pipelines is a long shot. And what about the huge question mark of carbon taxes?
So what does all this mean for the stock price? This little visual from the report tells the story pretty clearly. On the left, you've got CNQ, and you can see its current price is trading above what the analyst thinks it's actually worth. In other words, it looks overvalued.
On the right, for comparison, a competitor like ConocoPhillips is trading pretty much right where it should be. And if you want the hard number, here it is. After all their work, Morningstar's fair value estimate for Canadian natural resources lands at 43 Canadian dollars per share.
So the final verdict is a 3-star rating, which basically means it's considered fairly valued. But, and you really got to pay attention to this part, it comes with a massive warning label: high uncertainty. That means even though the price seems about right today, the road ahead could be pretty bumpy.
And that really leaves us with the big question, doesn't it? The company has solved its biggest problem. It forged a new moat out of steel. But with future growth still hanging on the hope of even more pipelines, and the shadow of carbon taxes getting longer, is that new moat really wide enough to protect it from whatever comes next?